What sort of probability are you putting in terms of an acquisition happening this year?
Well, I think about 50-50 lah. It's still hard to say. Yeah, but management is working hard to get the right one.
Got it. Okay, so that's another extra catalyst if that happens. Now, Jarek, one of the stocks that hasn't done particularly well is Franken. The stock's down about a third just in the past month alone. Yet you say that this is a very good entry opportunity for the stock. What are you seeing that the market is missing out on?
Sure. I think if you look at Franken, basically the fundamentals, this has always been our topic. Fundamentals has been quite good. I think fundamentally, this is the only semicon tech stock in Singapore that's showing year-on-year, Q-on-Q growth. And I think that, after this round of Q2 results, it will even show that they are the cream of the crop for Franken. If you look at the share price weakness in the last few weeks, basically I think it's just mainly due to market, where the market there was a tech sell-off and then the market was quite volatile as well. So Franken being a high beta stock, the correction was mostly due to market movement. So as a result, we think that when the price dropped so much in the last 2-3 weeks, which is not due to fundamentals, then likely there is it's a very good buy after such a big correction, especially with results coming out on Wednesday, which we think that will likely perform better Q-on-Q and year-on-year as compared to other players like UMS and AEM, which will likely report quite bad results. And also, I think Franken's outlook is also quite positive, and management should continue to guide a very positive outlook. So with that, we think that the share price has corrected quite a lot and is due for a good rebound when the numbers come out.
Right, and we got three more days or so to go for the numbers to come out. So that this is probably a good window to look at this stock right now.
Yep.
Okay, thanks, Jarek. Thanks for joining us.
Thanks for having me. Thank you.
So I actually want to jump into technicals right now because technical analyst is actually highlighting CSC and Dynamac as two trading buys right now. So one of his topics is CSC. He says that the share price correction may have concluded and we are in for a rebound, and it actually might rebound and challenge CSC's previous high. So do have a look at our technical charts on that one. Also, a similar sort of story for Dynamac as well. I think the recent stock correction has hit a low of Sing dollars 0.485, and momentum has started to pick up again. So I think at this stage, our technical analyst says stock is worth looking at, and it's probably in for a breakout run as well. So CSC and Dynamac, both from a fundamental point of view as well as from a technical point of view, giving out some very strong signals that the time is right for these stocks. With that, let's bring our macroeconomist in. We've got Erica on the line. Now, Erica is here to help us make sense of China. Consumer good inflation saw a positive reading for the first time in about 16 months, growing at about 0.5% in July. Can you, Erica, put this into context and also share with us how significant this development is?
Sure. Thanks for having me, Chilan. So for China's consumption, I think we have all been closely watching when the Chinese consumer will be out of intensive care in the last 6 months. So you've seen consumption stocks, becoming better, whereas China's in a two-speed economy. So industrial production, especially high-tech export sectors, were doing super well. So I think a bit of good news there from July's CPI numbers. So the prices of consumer goods in China have finally started to increase, albeit by a little bit. So it rose by 0.5% in July year-on-year. What's significant is that this is the first time in 16 months that consumer goods inflation has turned positive. So what's been happening before that is because consumer demand in China is soft, so retailers have been engaging in price wars and cutting prices of things from electrical appliances to automobiles, and that has sank the consumer goods inflation. It's been in negative territory for more than a year. So finally, with the July reading, I think there are signs that there's an end to the price wars in sight, and that will spell good news for companies' margins, because they have been having margin compression due to the price cuts.
Got it. So I think we're going to start to see some margin improvements happening, and it's certainly a good sign. Do you think that there will be more policy support as well coming from the Chinese government to lift consumption?
I think so. I believe so. After the recent Politburo meeting, which is a quarterly meeting of top policymakers, they actually made a mention that economic policies will henceforth put more focus on boosting consumption. So this is a huge policy shift. So for the first time in a long time, putting consumption as a priority. And then immediately after that, last week, the State Council, which is China's cabinet, has announced 20 steps to boost services consumption. So it mentioned steps to encourage Chinese citizens to spend more on childcare, elderly care, and also to upgrade tourism to sectors such as concert tourism and sports tourism, and also a specific mention on tuition. So as we know, China has come down quite hard on after-school tutoring last year, because they don't want children from the better families to enjoy an unfair advantage. So this time the directive was quite nuanced. The State Council would like to encourage non-academic tuition. So we can perhaps look forward to more initiatives or more measures to encourage things like music lessons.
Right. Non-academic tuition. Okay. More ballet classes and music, I suppose. Now, the consumption side is only like one engine of China's growth. I mean, exports is also a big contributor. Now, July exports actually came in slower than expected. What does this mean, Erica? And is this something that we should be worried about?
So July exports indeed came in a little bit slower than June. So it grew by 7% instead of 8.6% in June. But I think the numbers are actually better than it looks, because the July number was actually weighed down by a retraction in petroleum exports. But if you look at the things that China is trying to push, right, high-tech exports, that actually grew by 12% in July, which is double the pace of growth in June. And if you look deeper within high-tech exports, integrated circuit chips up 23%, automobiles up 13%. So very healthy numbers there. And we also notice that, despite what we just discussed about weak domestic demand, actually China's imports rebounded in July, so it rose by 7%. So what's going on there, we believe, is the companies in China trying to stockpile components. So we saw a 24% rise in Chinese imports from the US. So this is quite interesting. So we think that this is probably a sign of US companies trying to ship as much components to Chinese customers, before further trade restrictions make it difficult to do so next year.
Right. So it's a very sort of sensitive path that some of these companies have to tread on. But I think this is what really matters. It's really about reading between the lines. I mean, when you look at the headline numbers versus what is actually happening on the ground, you do see some positive developments. And thank you, Erica, for bringing us that.
Thank you.
Now let's go back to stocks, and let's bring Hussaini on the line to talk about Singtel. Hussaini, are you there? I think we just got to give him a second to get online. I think just to give some background, we have seen Singtel's stock dropping about 3% today, with news coming that Optus fell out with its mobile towers investor Australian Super, which is Australia's largest superannuation fund. So Singtel, Hussaini, maybe you can give us, walk us through what happened and what are the implications here for the stock?
Hey, Thilan, thanks for having me. So let me step back and give a bit of background. So in 2021, Optus sold its towers to Australia Super, and at the same time, it committed to lease back around 500 or more than 500 new towers, which the TowerCo had to build. So far, TowerCo has delivered around 200 towers, and the shortfall will result in the penalties in our view. Okay. Now, from the article, it is not clear who has to pay penalty to whom, but based on our understanding, Optus should receive the penalty as TowerCo has failed to deliver. Okay.
Right.
So that said, Australia Tower is a small part of Optus or as a Singtel as a group. So we estimate the SOTP contribution of Optus Tower to be very minimal at around 1%. So in our view, the P&L impact should be fairly minimal. So all in, I don't see the news as a major development to trigger a 3% stock correction. If at all, it is positive for Optus from the P&L point of view, because in our view, Optus should receive the penalties. As such, we see this correction as a buying opportunity.
Right, so it's a knee-jerk reaction. So there is a potential for buying the stock now. So actually, we are going into Singtel's first quarter financial year 2025 results, which is out on the 15th of August. So this might actually be a catalyst as well. So Hussaini, what are you expecting for those results?
So we see a decent delivery in first quarter. We expect earnings to be up 7% year on year and 5% quarter on quarter. If you see, all of the Singtel associates have already reported, with AIS and Globe Telecom posting double-digit earnings growth, which came ahead of expectations. Other two associates, Telkomsel and Bharti, was in line. At the core business, we expect Optus and Singapore Mobile to post a decent mid-single digit year-on-year top-line growth. On the margins front, we expect around 1 to 3 percentage points improvement at Optus and NCS levels. So all in all, a decent operational delivery in our view. The only offsetting factor was the FX, with Singapore dollars strengthening against most of the currencies. So all in, we expect a decent delivery with no major areas of concern going to first quarter results.
Got it. So decent delivery, knee-jerk reaction in terms of stock performance today. So could be a good entry opportunity for Singtel as well. I've got a question from the audience, from Mr. John Tan, who's asking, following bank earnings, are they the best dividend picks? If not, what else should I look at? And I think, Singtel, given, a 5-6% sort of yield, is actually a pretty good stock to look at as well at this stage. Now, talking about banks, last week we saw the announcement that there's a changing of the guard at DBS, with CEO Piyush Gupta announcing his retirement after 15 years at the bank, and Tan Su Shan taking over from March 2025. Now, for first off, I don't think in terms of the changing of the guard, this is not really a major surprise. There has been quite a bit of rumors on the street that Piyush Gupta is looking to retire, and Tan Shu Shan was one of the front runners. So I don't think there's going to be a major surprise there. Now, from a strategy point of view, we don't think there'll be a big shift in DBS as well. If you look at Sushan, she has been with DBS as long as Piyush Gupta has, and has actually been part of the transformation process of the bank from being a wholesale bank to a more universal bank with a big wealth franchise. And she has actually headed wealth. She's been with consumer. She's now heading the institutional business as well, which together is about 90% of DBS's revenue. So she's very familiar with how the bank is being run. Now, having said that, as she takes over in March 2025, she will have some critical challenges to address. The first is slowing North Asia, particularly Hong Kong, China, where about 1/3 of DBS's exposures are in. So I think this will require her to re-strategize what to do with North Asia. The second is within her first year of tenure, we probably will be in full-blown interest rate cuts. So again, DBS has enjoyed a strong interest rate expansion and margin expansion over the last 2 years. So she will have to deal with the interest rate cuts. And finally, DBS has about $5 to $7 billion of excess capital, which in the past management has said that they do want to return back to shareholders. So we will have to see whether this will be something that the new CEO will stay the course on, or whether there will be a course change here as well. So I think in terms of continuity, stability, we don't think there's going to be much change. Obviously, there will be some strategic calls that the new CEO will have to make. We are keeping a buy rating on the stock. We think that overall dividend yield of the stock is very, very good, and they will actually have the ability to hold on their margins a little bit better than UOB and OCBC as interest rates come down. So I think for John, DBS would still be one of our preferred dividend picks as well. We think some of the REITs like CICT and CLAR are also interesting at this stage, but you may have some volatility in the near term as interest rate goalposts get shifted around. With that, let's go to what's happening in terms of upcoming events and dates. We've got quite a few results coming out. CICT coming out 13th of August, Wilmar also on the 13th of August, and then Genting Singapore 14th, CapitaLand Investment on the 14th. In terms of other events that we are hosting, if you go to the next slide, we've got quite a few events. We are hosting SIA Management today. I hope that you have got your sign-ups already in place. We've also got SGX Discovery Night happening on the 22nd of August. You can sign up for that by directly scanning the QR code on your screen right now as well. And with that, we are out of time. Thank you very much for joining us as always this week. We really appreciate all your support and have a fabulous trading week ahead. Thank you.
Recording stopped.